Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Nebius Group.
If you find our talks useful, please consider subscribe, like, and comment underneath. We really appreciate it. And, it helps us keep bringing you these analyses. So imagine watching a company lose roughly 40% of its market value in this dizzying slide.
Yeah, a total free fall.
Right. Only for the undisputed king of the AI sector to just quietly step in and scoop up a massive 9% stake while all the panicked retail investors are basically rushing for the exits.
It is wild to watch.
It really is. And that is the exact tension we are exploring today with Nebius Group, trading under the ticker symbol NBIS. We are looking at a $775 million bombshell of a debt deal, a massive endorsement from Nvidia, and, well, trying to figure out if this is a dip buying opportunity or a falling knife in the AI cloud infrastructure space.
The underlying mechanics of what is happening with this stock right now, it provides a masterclass in market psychology and institutional maneuvering. But before we break down the exact implications of that Nvidia stake and the technical support levels you need to watch, here is a useful chart tool for those of you actively navigating these markets.
Always good to have the right tools.
Exactly. If you want help reading trading charts more clearly, you can check out VIP Algos. The link is below in the description. VIP Algos is a TradingView indicator suite designed to give you clearer visual cues. It shows visual buy and sell chart alerts, helps identify trend direction, maps out support and resistance zones, and, even outlines areas for take profit and stop loss planning.
And just to be absolutely clear for everyone tuning in, VIP Algos is strictly an educational chart analysis tool. It is not financial advice. It does not place trades for you, and it carries zero guarantees.
Right. Meta.
Trading always involves risk, so you must do your own research. And that link below in the description is an affiliate link, meaning we may earn a commission if you use it at no extra cost to you.
Perfect. So let's move into the wealth building context here. When you are staring at a 40% drawdown on a chart, it is very easy to get tunnel vision.
Oh, absolutely. The panic just sets in.
Right. But what does a company like Nebius actually represent for a long-term portfolio?
Right.
They operate as a neo-cloud infrastructure play.
Okay, let's define that, because neocloud sounds a lot like, Silicon Valley marketing jargon.
It really does.
If I am a developer building a massive artificial intelligence model, why am I going to a neocloud instead of just knocking on Amazon or Google's door or, I don't know, just buying my own chips?
Well, think of traditional cloud computing, like renting a reliable sedan for a cross-country road trip. It gets the job done for 99% of businesses hosting websites or storing data.
Sure, that makes sense.
But what Nebius is doing is renting out Formula One cars, complete with the pit crew, the specialized fuel, and the aerodynamic track. You can't just buy a single Nvidia GPU and expect to train a world-class AI model.
You need a whole fleet of them.
Exactly. You need tens of thousands of them, all clustered together, communicating with zero latency, utilizing highly specialized networking infrastructure. Nebius builds those exact high-performance clusters.
Ah, I see.
Yeah, they don't try to host your company's email server. They exclusively provide the raw, hyper-dense computational power required to bring artificial intelligence to life.
So the thesis here is completely structural. It's like the 1800s railroad boom. Right?
Oh, that is a great analogy.
Like, you don't necessarily have to guess which specific software company will build the winning app. You are just banking on the reality that whoever wins will need an unfathomable amount of raw compute power.
Yeah.
You want the companies laying the most critical track.
Precisely. You are investing in the underlying physics of the industry. The demand for computational power is not just a fad, it is a secular tailwind.
A one-way street.
Completely. That gives us the bigger picture. Now let's look at the fundamentals, because the numbers Nebius is generating from this demand are just staggering.
To hear them.
We're talking about a company sitting on a market cap of $44.72 billion, with trailing 12-month revenue growth of 527.97%.
Boy, I have to stop you right there.
Go ahead.
Over 500% revenue growth on a multi-billion-dollar valuation. That usually comes with a massive glaring catch.
Usually, yes.
Right, because historically we have watched endless tech startups post hyper-growth numbers on the top line while just absolutely hemorrhaging cash. I mean, they basically buy their market share by burning cash at a loss. If Nebius is buying billions of dollars worth of physical hardware, what do the actual margins look like?
This is where the narrative completely detaches from that typical cash-burning tech trope. Nebius operates with a trailing 12-month gross margin of 72.06%.
Wow.
And more importantly, their net margin sits at an almost unbelievable 93.09%, driving an earnings per share of 2.73.
Okay, a 93% net margin for a company that buys physical, depreciating hardware. You have to walk me through the mechanics of that because on the surface, the math just doesn't seem to compute.
It sounds impossible, right?
Yeah, I mean, hardware gets old. Servers need replacing. How are they keeping 93 cents of every dollar that hits the bottom line?
It comes down to absolute unadulterated pricing power and utilization rates. Right now, top-tier GPUs like Nvidia's H100s are the most scarce, highly coveted commodity on the planet.
People are practically begging for them.
Literally. Demand so fiercely outstrips supply that mega-cap tech clients are willing to pay astronomical premiums just to lock in guaranteed access to these clusters. Nebius doesn't have to discount a single server to win business.
They just name their price.
Exactly. And once a massive cluster is built and plugged in, the marginal cost to deliver that computational power drops significantly. The clients sign massive long-term ironclad contracts at premium rates, so the revenue just aggressively outpaces the depreciation schedule of the hardware.
Right. So the EPS of 2.73 proves they're capturing real cash flow, not just some revenue mirage.
You nailed it.
Okay, I see how the premium contracts juice the margins. But that brings us to the $775 million elephant in the room.
The debt deal.
Yeah. Right in the middle of this 40% stock price haircut, Nebius secures $750 million in senior secured debt. For anyone managing risk, taking on that much debt feels really precarious. Why not just issue shares if they need cash?
Well, the structure of this debt is actually the most bullish fundamental signal they could possibly flash. This is an asset-backed debt facility. They did not just go to a bank and ask for an unsecured loan based on a pitch deck.
So what did they use?
They used their existing, highly coveted GPU servers and their contracted future revenue as hard collateral. The real insight here is that traditional risk-averse Tier 1 banks now view GPU servers and compute contracts with the exact same ironclad reliability as commercial real estate mortgages.
Okay, let me make sure I have this right. They took these guaranteed contracts from their biggest clients, which includes companies like Meta and Microsoft, walked into the bank and basically said, this revenue is legally binding, lend us money against it.
That is exactly what happened. And the reason this is so critical for your portfolio is what it prevents, which is equity dilution.
Ah, right.
Usually a high-growth company needing nearly $1 billion for expansion would just issue millions of new shares. That floods the market and dilutes the existing shareholders.
It makes your slice of the pie smaller.
Right. But by securing asset-backed debt, Nebius funds their massive global expansion without diluting the equity of the shareholders at all. It is a massive flex of their balance sheet strength.
That is huge.
Yeah.
Now let's talk about the other half of that bombshell. You mentioned Nvidia took a 9.3% passive stake in Nebius.
Yes, a very strategic move.
On the surface, the kingmaker of the industry buying nearly 10% of your stock is incredible. But let me play devil's advocate here. If Nvidia controls the entire global supply of the chips Nebius needs to survive, doesn't that make Nebius just a glorified middleman? What is their competitive moat?
It is a vital question. Nvidia absolutely controls the ecosystem. But you have to view that stake not as control, but as a strategic anointing.
A VIP pass, basically.
Exactly. Nvidia is the bottleneck for the entire AI revolution. By taking a near 10% equity position in Nebius, Nvidia fundamentally aligns their own financial interests with the success of Nebius.
So when the supply chain gets tight.
Right. Who receives priority allocation of the newest, fastest hardware? Is it some random startup or the NeoCloud partner that Nvidia actually owns a massive chunk of?
Obviously the partner.
Right. This creates an impenetrable barrier to entry. A competitor could have $1 billion in cash, but if Nvidia won't sell them the chips, they have no business.
That gives us the business picture. Now let's move to the catalyst timeline. What forces are actually going to move this stock in the coming months?
Well, the most immediate catalyst is their upcoming earnings report. The market has rewarded them for the debt deal and the Nvidia partnership. Now, Wall Street demands execution.
It's showtime.
Exactly. The earnings call will be the true test to see if Nebius can rapidly plug in all this new GPU capacity and instantly convert it into realized revenue. The market wants proof that the growth rate is sustainable.
We also have to zoom out and look at the macro environment, right? You see escalating geopolitical tension, like the ongoing conflict involving the US and Iran, shipping lane blockades, and just general energy supply disruptions. How does capital flow around an infrastructure stock during all that?
We're seeing a very specific psychological behavior from institutional capital. During geopolitical shocks, capital tends to flee physical goods and flow directly into digital infrastructure havens.
Because AI development is structurally immune to a shipping blockade.
Exactly. A delayed oil tanker does not stop an engineer in Silicon Valley from meeting compute power. So, investors park money in secular tech trends to avoid physical world volatility.
I do have to challenge the idea that they are completely immune, though. I mean, these data centers are physical facilities. They require absolutely massive amounts of electricity to run, plus the industrial cooling systems.
Oh, the power draw is immense.
Right. So if global energy prices spike violently because of conflicts, doesn't that immediately crush their operating costs?
It is a very astute observation. Energy costs are their primary variable expense. However, Nebius runs an asset-light cloud model. They strategically position their data centers in regions with isolated, stable power grids, and they lock in long-term, fixed-rate power purchasing agreements.
So they aren't paying spot prices.
Exactly. While a massive energy spike poses a marginal risk upon contract renewals, they're largely insulated from month-to-month volatility. The institutional money knows this.
Okay, so catalysts tell us what could change the story. Now let's pivot to the chart. We established the stock is down 40% from its highs. What is the actual price structure doing right now?
The psychology of this chart is just fascinating. Right now, NBIS is trading around $182.62. It is up nearly 2.8% on the day.
Showing a bit of rebound.
Yes. But to your point, it is down 39.1% from its 52-week high of almost $300.
Now, if you are an average investor and you watch a stock plummet from nearly 300 down to 182, panic usually sets in. Does a drop of that magnitude signal a broken trend?
It looks violent in isolation, but you have to pull back. Even including this recent pullback, the year-to-date returns are a robust 118%. Prior to this haircut, the stock had gone on an absolute tear, running up over 245%.
So it basically sprinted a marathon, got completely exhausted, and is now just taking a healthy consolidation rest.
Exactly. What is crucial is where the stock stops falling. The chart shows that Nebius found rock-solid support around the $179 level.
Explain the behavioral mechanics of that. What does finding support actually mean here?
When a stock falls that hard, you have a massive influx of panicked retail investors dumping shares. But the fact that the price completely stopped dropping at 179 means heavy, institutional buyers drew a line in the sand.
They saw it as a bargain.
Right. They digested the Nvidia news and the debt facility and decided 179 was an absolute steal. They completely absorbed all the panic selling.
And we see evidence of that in the volume dynamics too, right?
We do. The 10-day average volume sits at 17.84 million. But the most telling technical signal was the recent gap up on neutral volume dynamics following the Nvidia news.
Which means what exactly?
It means sellers appear completely exhausted. There were literally no sellers left willing to part with their shares at the lower prices. So buyers had to actively bid the price significantly higher just to find a single share.
It is always important to remind everyone listening that charting shows probabilities, not guarantees. But when you marry a structurally intact business with exhausted sellers at major support, it's highly compelling.
It creates a coiled spring effect.
So the chart gives us price structure. But what does market sentiment look like? Are the insiders actually putting their money where their mouth is?
Well, the market narrative is decisively bullish, mainly driven by that debt deal and the Nvidia stake. But to answer your question about insiders, there is a stark contrast.
Let's hear it.
Nvidia represents massive institutional accumulation. But on the flip side, corporate insiders at Nebius have sold 1.6 million shares over the past 90 days.
Okay, wait. Executive dumping always flashes a red warning light for me. Is this insider selling a massive red flag? Do they know something we don't?
It is a natural instinct to feel cautious. Insider selling is, by definition, informed bearish positioning for those specific shares. We have to contextualize it. First, it is entirely typical corporate behavior to see executives take profits after a 200% annual run-up. Second, look at the math. 1.16 million shares is a drop in the bucket. It is completely marginalized by Nvidia's massive 9% endorsement.
That sentiment picture is useful, but we still need to talk about the risks. What is the absolute worst case scenario here?
The biggest bear case is hyperscaler in-housing. Think about a behemoth like Meta. They rely heavily on neoclouds right now, but what happens when Meta finishes building out their own internal massive data centers?
They cut out the middleman.
Exactly. The bear case argues they will eventually cut out neoclouds like Nebius, leaving them with depreciating servers and no clients.
But there is a massive paradox here. Meta is rumored to be cannibalizing neocloud demand, yet they are explicitly listed as a key contracted customer backing Nebius's debt facility.
Right.
How can they be the threat and the foundational backer?
It perfectly illustrates the sheer desperation for compute power. Yes, Meta wants to build their own capacity, but they simply cannot build it fast enough. They are physically constrained by time.
So they have to use neoclouds to bridge the gap.
For the foreseeable future, yes. The reality is likely a hybrid model that spans many years, which is why banks felt secure lending against those contracts. We also need to consider macro risks.
Right, the beta, Nebius has a beta of 1.055.
Exactly. This stock moves slightly faster than the broader market. If broad risk-off sentiment hits from global supply chain disruptions, like the U.S.-Iran conflict, it could pressure the stock heavily, even if they are physically insulated.
So with everything on the table, what's the final verdict?
The final bullish score stands at an 8.5 out of 10, and the investment horizon is categorized as a multi-year hold.
Just to summarize that, for everyone listening, you have an elite company with 527% revenue growth, trading at a 39% discount. They secured a massive debt deal without diluting equity, and they have the ultimate vote of confidence with Nvidia taking a 9.3% stake.
Exactly. But you must carefully weigh that upside against the hyperscaler in-housing risk and the macro volatility.
And as a reminder, this discussion is purely for educational purposes. It is absolutely not financial advice. Always do your own research.
Definitely.
And if you are looking for a cleaner way to read trading charts with visual buy and sell alerts, support and resistance zones, and help planning your levels, check out VIP Algos. The link is below in the description. Again, it is an educational tool only, does not place trades, and does not guarantee results. Trading involves risk. This is an affiliate link, and we may earn a commission at no extra cost to you.
And if you found this breakdown helpful, please subscribe, like, and comment. We'll see you in the next Smart Wealth with Joshua episode.